Howdy there, folks. Welcome into today's video on the Reaction Channel. One video only for me to react to in this one. I just watched a great, about 17-minute clip here on Closing Bell, back and forth about where this market's headed, what's actually going on here beneath the surface, many other various things. And I was like, oh, this is such a great segment to react to on the Reaction Channel. So I just want to get straight in this one. I appreciate y'all being here. Thanks for being subscribed. New all-time high subscribers in the history of the channel. 33,500 plus now. So appreciate y'all being here. And yeah, let's just jump into this.
Welcome to the Closing Bell. I'm Scott Wapner, live from Post 9 right here at the New York Stock Exchange. This make or break hour begins with this increasingly edgy market. Rates moving higher, China weakness worries, and an economy here at home that might be too hot for comfort. Add it all up, it's been a tough session for your money. Your scorecard with 60 minutes to go looks red. The Dow dragged by bank and industrial stocks all day, while more broadly, energy and materials weighing pretty heavily on performance today. NVIDIA, about the only thing going for the NASDAQ. Its two-day bounce back continues. Star analyst Stacy Rascon, meantime, is coming up in just a bit, where he thinks those shares are heading ahead of earnings next week. I mentioned yields. Take a look. The 10-year hitting its highest level since last October. That was earlier today. Retail sales coming in better than expected. And how about the Atlanta Fed taking GDP and its forecast up to a stunning 5%, believe it or not. It brings us to our talk of the tape. Just how vulnerable are stocks right now? Let's ask Adam Parker. He is the founder and CEO of Trivariate Research, a CNBC contributor.
So this show's about an hour before the market closes. Let me see. I think things deteriorated into the close. So let's see where we're at here. Let's go to my current stocks and indexes here. Sometimes TradingView is a little behind. So it looks like the Russell got worse as the trading day went on. S&P 500, NASDAQ as well, and the Dow Jones Industrial Average. So literally everything got worse from basically the time this was recorded. PayPal was a big loser today, but that's all right. We'll gladly take some shares off the market on Friday. We do appreciate that. And not much for green here today. I mean, looks like Avant's green. Looks like, well, SH is against, I don't even know why I still have that because I'm not against SH. It looks like Cake's green, and that's it. Literally. Estelle's green for me, Avant's green for me, and Cake's green for me. Outside of that is Red Dead Redemption out there. Let's take a look at big tech stocks here today. Yeah, not much for green. NVIDIA slightly got a green, and Oracle got a green as well. And let me check the public account and see how much we were down today in regards to public account. Ooh, this should be interesting here. What is the number gonna be? Well, it looks like $37,641 to be exact for the public account down here today. Ooh, boy.
And he is back with me at Post 9. It's good to see you again.
Good to be here.
Do you feel like stocks are vulnerable? It's been a rocky couple of weeks, especially for tech. But what do you think?
The earnings season I thought was, most of it's over. I thought pretty good.
Better than feared, for certain. Better than feared.
Right? The big cap tech stocks, basically every single one of them, the 2024 earnings are higher than they were on July.
So generally speaking, I agree with that. A little better than feared. Other than AI-related stocks that were a disappointment. Obviously, the biggest of the big AI stocks are still coming, NVIDIA. But yeah, I feel like earnings season in general was a little better than feared. It wasn't super exciting. We got some definitely positive commentary about the back half of the year for certain business models, and that's good news.
2024 earnings are higher than they were on July 1. So I think the fundamentals from the companies look okay. I think what's happening is a little bit of fear about the perception about interest rates, right? And how that means people will probably not want to pay as high of a multiple as they did a month or two ago. I think that's what's in the price right now. You talked about rates backing up, and for a long time, the relationship between the perception about rates and the price-to-earnings ratio was very strong, and it kind of broke in May when people said, hawkish doesn't matter, we're near the end of the cycle, I don't care if the Fed's hawkish. And now I think people are saying, well, wait a minute, maybe that's a little farther off than I thought.
Well, because even one time, doves like Kashkari today was saying, I'm not ready to throw in the towel just yet on this idea that we're done raising rates. 5
cuts are in the price by Jan 25. If you look, depending on what function you type in, I don't know any equity investor I talk to who believes that. So I think ultimately maybe people are saying, all right, they're going to be a little more hawkish than what's in some of the, bond guys, survey answers.
What about this idea that Leisman was putting forth today? We had him on halftime where he was talking soft landing good, no landing no good. No landing, no good, because that just means the economy's too hot to handle, right? We keep praising how good some of the data is as it relates to the consumer, like retail sales today. But the inverse on that is that, well, maybe that makes the Kashkaris and company be more aggressive than we actually think.
Yeah, the scary part of that is, the super scary part of that is, to put it very simply, is if the economy stays hotter for longer, you run much more of a risk of inflation staying in elevated place, right? CPI, PPI, all those, right? If that happens, this is where things could get ugly, okay? Because that means the Fed has to keep rates higher for longer. And the reason that's such a problem is the longer the Fed keeps rates in an elevated place, especially versus where they've been for the past 20 plus years, right? In an elevated place, the more risk it has to the economy being hit hard. I'm not talking about a little like, oh, we have a little minor recession. I'm talking about deep, dark, bad recession, okay? And by the time by the time the Fed tries to pull it out, it'll be too late by that time. The dominoes are already going to be falling all over the place, okay? And remember, the Fed lags. It's 1 to 3 years in terms of things getting ugly, right? From the time the Fed starts hiking. It's also 1 to 3 years until you get things back in a good place. So let's say, hypothetically, things start to get ugly in 24 at some point in time, Fed starts cutting rates. Cool. It's still going to be 1 to 3 years before the economy really starts to recover in any meaningful way, which means all of a sudden you got 12 to 36 plus months of pain ahead in the actual underlying economy with unemployment, all those sorts of things, okay? So that's the scary part of if the economy stays too good for too long. And that's usually a thing you have to worry about unless you're in a high inflationary moment in the economy, and that's exactly what we are. And especially late stage, that's the even scarier part.
And industrial activity are high but declining a little bit. Wage growth is not as high as it was. Industrial activity is not as strong as it was. It's still pretty good in absolute terms, but it's declining. So I think if you believe that continues, maybe you're okay. I think the bull case that was forming, a week or two ago when the market was kind of above 4,500 on the S&P and looking strong, was maybe people thinking, you know what, maybe we're at the beginning of a new earnings cycle that could just last several years. And so, because the market never trades for a long period of time above 20 times forward earnings. It just doesn't. So if that's right and we don't have a correction, either we're at the beginning of a multi-year earnings cycle.
You think we are?
It's possible. Or the 24 numbers are too low, which I don't think is the case. I don't think the 24
too low. Some people are suggesting they're still too high.
I think they are. I think the consensus is they too are, but they're too high. But if the market's going to trade at 20 times, it's telling you earnings are going to be better than people think. Or maybe we're just going to slowly go higher for several years, in which case you'll be a little more anticipatory this cycle. I think that was a narrative until very recently now, the last couple of days, where people are saying, you know what, they may end up a little more hawkish than I thought finally.
You watching yields or equities more, sort of as a tell on kind of where you think we are, right? Because it's been, as I said, a couple-week pullback in tech. Market's been hanging in, though. I mean, look, even today, right? You're worried about China. 10-year hits its highest level since October. I mean, Dow's down 0.8%. It's not like we're having a major problem here.
Right. I mean, you and I were on the air together 80 times last year, where it was worse than today, right? So I don't.
You were here for like 77
of the worst days.
Exactly. At the 80.
Yeah, so I'll take a little 80 bips. Like that's nothing.
Yeah.
Exactly. I mean, a fall like today, even I know things deteriorated more into the close, but this is like literally nothing. Especially if you went through the market of last year, this is like little child's play stuff. Like this is easy. Cake little drops to take in regards to this. Like, you're seeing real drops when you see Dow down 600 in a day, 1,000 in a day. When you have a week where the Dow Jones is down 1,500 to 2,500 points, that's when you're in a real, true rough market. This is what I call just playing around, trying to figure out where we're going here, right? And what's the market waiting for? I'll tell you exactly what the market's waiting for. The market's waiting for one specific thing. And that one thing is NVIDIA earnings. The whole market's waiting on these NVIDIA earnings. We know that's the leader stock in the entire stock market this year. That's the one that let us out of the depths of Q4 of 2022, obviously. It's been our fearless leader, has been NVIDIA. It's been more of a fearless leader than any other stock in the market, whether it be, stocks like Microsoft or Apple or anybody like that. No one matters more to the stock market right now than NVIDIA. And so everybody's waiting on those earnings next week, and we'll see.
But I think it's, look, the two things that matter the most are the perception about interest rates. So, where do people think they're going to be 12 and 24 months from now? And growth. And I don't think the growth numbers have given people cause for concern. So I think it has to be this perception about rates that's causing the pullback now.
So, you've always looked at technology because it's sort of what, a hat you used to wear in terms of semis.
Right.
As we look at China and where we think demand is, how much does it matter to our market right now that China's weaker than we expected it to be? Because it's not like this just popped up today where we say, oh my God, they cut rates. They're trying to stimulate a weak economy. The recovery has been weak for months and months and months, and it hasn't really mattered to U.S. stocks.
Two things. I think one is when it's bad there, people just assume bad is good because it'll catalyze them to do more stimulus and people are anticipatory. And two, look, other than a few very concentrated and exposed semiconductor companies to AI, most of them have overproduced consumption massively. The big story in COVID was factories shut down, you couldn't get silicon. So what happened is everyone ordered as much as they possibly could, and now we've overproduced. So most of these companies, look at Texas Instruments, TXN, they've got, 200 plus days of inventory. Great company, but they overproduced by a lot. So I think
that has an impact on prices.
Ultimately,
margins.
It should hurt margins. They can't run the factory as high, for sure. Right, and the fixed costs don't get amortized across as many units out. Micron, everyone knows everyone overshipped in PC area. That's probably well on the price, but everyone knows they built a year and a half too much inventory. So I think most companies have overproduced consumption, and the overall industry did well because the answer at every single paper on AI, the answer at the end was, I'm going to need more compute, and people just assumed all semis work. When the reality is, NVIDIA pro rata participates the most.
So when you look at mega cap, which is pulled back not substantially over the last couple of weeks, but enough to.
So I have this channel on Fubo, and I like watching this channel kind of like late at night, like here in Vegas time, like 10 to midnight, which would be obviously like that'd be like 1 a.m., 3 a.m. on the East Coast, right? And it's Bloomberg Plus, and I like watching this channel because at that time they're doing the European Open. It's a bunch of Europeans talking, also Asian market opens, so talking to a lot of folks in Asia and whatnot, right? Reporters, journalists, people that invest much more in the European markets and in Asian markets in general, right? And obviously CNBC very focused on what's going on in the U.S. stocks, and that's fine, but it's really educational to kind of find out what's going on outside the U.S., right? And what's very interesting is how bad China really is right now, and I feel like that doesn't get that much talk because we're so caught up in what's going on here. But China, from what I heard, youth unemployment in China is like over 20% right now. If that number's accurate, that's shocking. Over 20% for youth unemployment. They got real issues. And I was just watching last night, and China's already starting to cut interest rates, which kind of is very telling about the state of China right now, which is not in a good place, right? And they had the Rona shutdowns for far too long. They kept things shut down for far too long in Asia, and obviously China specifically, and it is really devastated their economy in a massive way. The good thing for us in the U.S. is we seem to have started to open things up, before things started to really deteriorate and get really, really ugly here in the States. Whereas China, China didn't finally start to loosen up till this year. That's just crazy to think, like this year.
As to what's up with that trade.
And see, the good thing with the United States is, especially in regards to Rona, is not everybody was in full agreement of like this should be shut down. Because we have the United States, right? Different states made different decisions. Some states were much more restrictive and shut down. Other states, like, for instance, in Arizona, I've spent a lot of that 2020, 2021 time, a decent amount at least, in Arizona. And I can tell you out in Arizona, you hardly knew Rona was going on. I'll just be quite frank, other than the fact that you were forced to wear a mask in like a public place, like let's say a food store or something like that. But outside of that, a lot of the restaurants were open, especially after that initial shutdown. After that initial shutdown, a lot of the restaurants started to open again. A lot of them had pretty good capacity, whereas other states obviously chose to make the decisions they made, right? And so that's a huge difference. In China, it's very different. China, if the government says this is the rules. This is what you guys got to do. Everything's shut down. It's not like, you can just make these different decisions and things like that. And this city over here, this state over here can say, you know what? No, we're not going to do what you guys are doing. We're going to do our own thing.
As to what's up with that trade. The knock before the pullback was these stocks are too expensive. Look at the PEs. Historically, they're too rich. Now, do you look at the pullback and say, okay, now they're better? They're better buys than they were? And what are you going to argue otherwise? You're going to say, well, I'd rather own cyclical stocks when we're just having a conversation about whether China is really weak and whether growth here is starting to slow even from a consumer standpoint?
My answer is I have to like them now more than I did 3 weeks ago because the earnings expectations are higher and the price is lower, and that's a cocktail I like. And my view is if I'm trying to beat the S&P 500 long only, the responsible thing for me to do is keep close to the index weight in those big names. I don't really know anything that's not in the price. I mean, come on, there's 60 sell-side guys and, I don't know, you tell me 40 million buy-side analysts on these things.
Yeah, but you get surprised. Look at what NVIDIA did last quarter, right?
Right. So
nobody knew that they were going to come out with that kind of guide.
Right. I don't want to be massively underweight or massively overweight the collective group of all of them. If you like NVIDIA more than you like, one of the other ones, you can go for it. But it's 30% of the index, and there's no way I want to own 20% and get run over if it outperforms.
Would you buy industrials?
That's one of our underweights, and the reason is because almost if I look at all the mistakes I've made in my career, and I'm old, and so there's a lot of them, the number one thing that explains those mistakes is I thought something was structural when it was cyclical. It went up a lot, I then decided I liked it, and then it rolled over. And every ounce of my experience tells me that these businesses are cyclical. Machinery is a cyclical business, okay? And so a number of things that industrials benefited from are slowing. Think about factory utilization. It was at an all-time high a year ago because we had very high nominal GDP. A lot of these businesses have non-U.S. labor. For all intents and purposes, there was really less wage pressure outside the U.S. because of our fiscal policy. Agricultural, aerospace, and defense were very strong end markets. They're cyclical. So I look at them and I think high inventory to sales, high earnings expectations, high multiples, and an emerging optimistic narrative. That's not a place I want to be overweight, knowing all the mistakes, cyclical, structural.
But you don't think that those...
And not to mention the biggest problem with those sorts of stocks, okay? The biggest problem is how much we've been in a kind of booming construction market for 10 years now in regards to homes being built, in regards to commercial space being built, right? In regards to big major projects, like it has been boom times for a decade now, to be quite frank. Obviously, low interest rates and a good economy for the last 10 years helped us there, right? And you can say, well, during Rona, the economy is maybe a little weaker, sure, but there was so much stimulus money out there that was like, here today, gone tomorrow type situation, right? So if you're going to talk about a major slowdown there on the economic front in all that building, a lot of those companies are going to get hit and going to get hit hard in regards to their businesses, which ultimately means their stock prices will fall in a pretty major way.
Well, I know, but you don't think that those, let's just say the more cyclical in nature stocks, like manufacturing's been in a recession, the data around manufacturing has not been good,
right?
And it's been consistently bad, but you don't think at some point it troughs, or maybe it is now?
It depends on the business. Some of the trucking data came out, the stocks missed by a lot, and the stocks went up because people think it's the trough on logistics. But if you're backing up and you're saying the industrial sector earnings expectations for 2023 and 2024 are very high, they grew a lot in 2022, and I think it's because most of these businesses couldn't meet demand earlier in the cycle. Right? It's not like they were amazing. They just couldn't get the silicon and logistics to ship it out. So now people think, oh, these businesses are going to grow forever. And there's a narrative about automation and reshoring and all this stuff that's fiscal stimulus for decarbonization. That's all true, but these businesses can't grow forever, have high inventory and high multiples. So I in the portfolio strategy, I'd rather take a shot at energy and metals only because expectations for earnings are way lower. They don't have the same inventory issues. Valuations are way cheaper. And so I can kind of barbell the strategy by being overweight energy materials and underweight industrials. I think that's the better risk reward.
All right, let's bring in Emily Rowland now of John Hancock Investment Management as we expand the conversation. It's nice to see you. So you've heard what Adams has to say. I said we have a market I described as a little edgy. How do you see it?
It was disrespectful. He's like, you heard what Adam has to say. She's like, yeah, I heard what he had to say. That was funny.
industrials. I think that's the better risk reward.
All right, let's bring in Emily Rowland now of John Hancock Investment Management as we expand the conversation. It's nice to see you. So you've heard what Adams has to say. I said we have a market I described as a little edgy. How do you see it?
Yeah, it's definitely edgy right now. We're seeing China obviously struggle to keep economic momentum going, while there's more evidence that the U.S. is seeing a bit of a reacceleration in economic growth. And that was evidenced by the retail sales data this morning coming in at a high 0.7% month over month. And frankly, this is the worst nightmare for the Fed, to see economic growth reaccelerating.
I called that. I told you guys retail over the next few months, in my opinion, is going to be in a pretty good place. I'm not so convinced about 2024, but over the remainder of 2023, I'm pretty confident retail is actually going to be looking good, especially lower price retail, meaning let's call it the under $200 bracket, and specifically the under $100 retailers that focus really on those sorts of products. High end, nah, I don't like that.
That tighten more, or at least hold for longer here. And what's happening to markets right now is they've been sort of in the boxing ring with the Fed over the last 18 months here, and they keep winning multiple rounds. They keep taking punches from the Fed in the form of higher interest rates. And now we're looking at an environment where we're backing up back towards last October's high in rates, and markets are becoming a little bit exhausted here. So I think that, the Fed is starting to wear the market down. We're seeing those punches starting to land, and that's what's creating a lot of this volatility that we're seeing.
Right. I mean, we went from, okay, economy's good. Hey, soft landing.
I actually don't think we've seen the punches land yet. I think in maybe a couple punches, but not really. I think many more of the punches will land next year, my personal opinion, which is why I'm making sure I do some proper hedges for next year, because I think there's a real possibility that some of those punches can land in a pretty significant way next year.
Hard to soft to know.
But now today we're saying, well, Adam, maybe no is no good, because it just means what Emily just said.
Yeah,
that the Fed's going to just stay engaged as long as the economy remains in their eyes, too hot.
Yeah, I would say the good is bad logic. I mean, for years we've talked about bad being good, right? If it's bad, the Fed will be there, it'll be good for stocks. And what you're saying now is we're in a good is bad zone. I don't think so. I really don't. I think if it's good, it'll be good. Meaning if the earnings continue to be strong, people will say, yeah, maybe there's one or two more hikes, but then they'll pause.
Yeah, but if the Fed allows it to be good, right? Isn't that a question at this point, right?
Yeah, and the other issue you run into is we've been saying that for a while now. Oh, the Fed's got maybe one hike left and they're done. Well, we've been saying that for, it's been almost a year now, right? Probably a little less than a year. It was kind of the thought process of, oh, maybe one, maybe two more hikes and they're done. But we've been saying that, and then they just hike further and further and further, right? And the further they go, for the longer they go, the more of a serious risk it poses to the economy and to the stock market.
Point, right, that we're back to wondering and worrying, are they going to make an error, go too far when they don't have to?
Yeah, I mean, if things slow and moderate, but they don't get cratered, I think that's okay.
I'm like 95% confident they're going to go too far. 95%. I think right now they should be cutting rates. My personal opinion. And I know we're not down that 2% CPI number and all those sorts of things. Remember, the Fed lags. So the moves they've been making here are still going to be felt over the next at least year, if not 2 years, okay? And so the problem is, if you wait till everything's in line, the inflation numbers, and then unemployment's already climbing and those sorts of things, and then you start cutting, it's too late. It's way too late. By the time you start cutting, you're pushing a year, 2 years, 3 years before you reverse things the other way. That's why you have to anticipate these things better, and that's what the Fed can't do. They can't anticipate. We knew inflation was already becoming an issue at the end of 2020, to be quite frank, and certainly into 2021. The Fed did not recognize inflation until March of 2022 and started raising rates. They were a year to a year and a half behind where they should have been, already raising rates, right? And so I'm pretty darn convinced, like 95% convinced, they're going to go too far this time, and they're going to be a year to year and a half behind where they should be. They might not be cutting rates till, mid to late 2024, when they should actually be already starting to cut rates, in my personal opinion. You've got to anticipate. It's like Wayne Gretzky used to say, right? Like this is just, Wayne Gretzky used to say, you got to skate to where the puck is going, not to where the puck is. The problem with the Fed is they skate to where the puck is, not where the puck's going. They don't anticipate anything. They're just like, what's the data look like today? And that's what they go off of. You can't do anything in life like that. You have to anticipate where things are going. Otherwise, you're just always going to be, it's like if I teach my kids to throw a football, I say, throw to where the receiver's going, not to where the receiver is, right? You're going to anticipate it. This is life. If you don't anticipate things, you lost. You lost. And the Fed loses again and again and again and again. The Fed's never won. They never will win. They're always going to continue to lose. Well, maybe Volcker back in the day. He was a little bit anticipation type guy. But the rest of these guys, man, they lag. They're behind.
Be good, and I think that would be good for equities and good for the outlook beyond that. So I guess what you're saying is right here, right now, today, is good economic news bad for the stock market? I'm going to say no, it isn't. I think good economic news will ultimately mean the market ends higher than it is now.
Emily, do you feel like I know some would suggest, well, we've been overdue for a correction because the year has been so strong. If we do get one, to what degree do you think we'll feel it?
Yeah, I think it's tough to say here. I do think that there is a possibility that we could retest last year's lows as the lagged impact of Fed policy does impact markets. I don't think we're there yet.
That's a big statement. That's a big, I'll give her credit because that's a big statement that a lot of people have walked away from. That was not a big statement 9 months ago. It was not a big statement 6 months ago, even 4 months ago. Now, even most of the bears have walked back their feelings about S&P 500 going back to the lows of last year. So I give her credit for putting her head out there and saying, yeah, the market's going back to where we were previously.
Environment which can see these big moves higher in risk assets. So we want to stay invested here. We just really want to be disciplined about doing so. So we look at the playbook right now. We still like technology stocks. They're the poster child for quality. These are companies with great, more steady earnings, good balance sheets, lots of cash, good return on equity. But of course, as you guys talked about earlier, technology stocks have run a lot. They look expensive. One sector that we'd be keeping an eye on here is...
Before she gets into one sector that I got to say, I agree with this lady a lot. I agree with her a lot. A lot of our approach in the market right now is very similar in terms of, you've got to really be picky in this market. You really got to choose best of breed companies, strong balance sheets, companies that generate, pretty meaningful cash flows. And that's kind of where I'm at as well. And kind of being in that standpoint of you got to keep some cash around right now because this thing could obviously go, let's call it a bad way. I think you've got to have some hedges on for next year, ready to rock and roll just in case some things transpire here. But you want to stay invested. And that's exactly where I'm at. I'm staying invested. If the market drops, the market drops. I got a lot of cash around. I'll be ready to buy in any sort of major significant drop, right? Obviously, my hedges would print money. If we have any sort of significant drop in the market, I can flip those over to longs. So you got to have a real good balance right now. A really good balance in this market. You can't just be in my opinion, you can't be all bear in this market or you can't be all bull. If you're either one, you're setting yourself up for some big potential problems because this thing could break either way easily. Or just staying kind of a mundane, like back and forth, not really going anywhere phase for 12 months.
Healthcare. We're starting to see it perk up a little bit. It's actually trading at a discount to the broad market. It has more defensive and higher quality attributes. It kind of feels like a flashback to the macro playbook of 2022, where we saw relative economic strength in the U.S., weakness overseas. We saw a Fed that was continuing to tighten and still concerned about inflation. So that's an area that we would look at. We also do think that bonds can start to kick in, and we'd be looking at every one of these backups and bond yields that we've seen as an attractive entry point to grab a hold of that income. 5.5%, 6% on investment grade corporate bonds to us looks pretty nice given what the macro backdrop is telling us.
See, Adam, here we are back again. It's alternatives to stocks that are attractive. Bond equivalents, you can get rates go up. You can still get, near 5% in your money market. So you still have those other places to go with perceived less risk than stocks.
So two things. One, I don't agree with that we can get back to last year's lows with the current way I'm viewing the world. Because to get the 3,600 in the S&P where we were last October, whatever that is, 20% down from here, you need to believe earnings are going to collapse, not erode. And I'm more in the erode and bottom and then accelerate into next year. So I think earnings will be higher next year than this year. And as long as I think that, I don't think we're going to go anywhere near last year's lows. That could change, but that's not what I see now. I think your point is what we call equity risk premium, comparing equities to bonds, and it's been the case since April of 22. I think I mentioned on the air with you, I bought the 2-year yield for the first time in my life at 5%. I've never done that before because you couldn't ladder CDs and beat it anymore. That looks attractive. The problem with that logic, or the challenge to that logic, is I think you can prove in years 5 through 10 that has predictive values, maybe in years 3 through 10, but it's just not effective for predicting return in a 6 or 12-month view. And I think a lot of cross-asset folks have struggled because the signals tell them to be overweight the bonds versus equities, and that I think is intellectually honest and right in years 3 through 10, but not in the next 6 to 12 months. So you have to ask yourself, how much can I tolerate if I was underweight? Do I go to market weight or overweight, hope to catch the 7th, 8th, and 9th inning of this, or how do you play it? So I think people are a little bit trapped in that from where they started.
It makes me think of a question I want to ask you, Emily, in terms of when do the bears, because there still are plenty, and I interview enough of them every day.
Yeah.
When do they throw in the towel? Like, what do they need to see? You still get the argument, well, there's still better places to be, either fixed.
To be fair, a lot of bears have thrown in the towel as this year has transpired and gone on. Obviously they're lurking, but I mean, a lot of them have thrown in the towel or gotten way less bearish as the year has ticked on.
Better places to be, either fixed income or in cash. What causes a turn? Is it a real chase for performance as we near the end of the year? What is it?
Yeah, I think if you want to be living on soft landing island, you have to see inflationary pressures come down meaningfully. And we're certainly moving in the right direction here, but there are a number of factors that have caused things like commodity prices to go up. You're seeing China stimulus. I think the jury's sort of still out whether that's pushing on a string or not, but it's, you look for things like copper prices going up, oil prices going up, those things contributing to headline inflation. And then the comps sort of starting to work a little bit the other way. They're not going to be as favorable as we move in to the next few months on a headline inflation perspective. So I think all of those things need to reverse gear in order to really declare victory here. But again, look, it's exhausting. The leading economic indicators have been negative for 12 months. The yield curve's inverted for 13 months. I think typically in these late cycle environments, investors do tend to capitulate. Soft landing gets priced in. You guys have been talking about no landing. That's not like a thing, because there wouldn't ever be any economic cycles. There will be a landing of sorts. And so I think that's important to keep in mind. Again, doesn't mean we don't want to be invested, but we want to be really mindful about how we're doing it. And I think risk management is critical today.
Sum it up, Adam, 30 seconds. Leave us with a thought now for the rest of this week.
Yeah, I think listen, I think there's a lot of agreement in what happened there. I just think, to get earnings down year over year, you need a different trajectory than the economy's currently on. So I'm, I'd say 60-40, think the market's next move is 10% up, not 10% down.
Cautiously optimistic,
yeah.
Is that fair enough to describe you?
I think that's right, and I think the big cap tech stuff, earnings look really good to me, and so the whole thing that I need broadening isn't going to be because they are bad. You need other stuff to have margin expansion.
All right, guys, I appreciate it. Enjoy.
Yeah, so I thought the best sentence was her, kind of sentence here right toward the end, right? That's just a thing of beauty.
Agreement.
I think that's important to keep in mind. Again, doesn't mean we don't want to be invested, but we want to be really mindful about how we're doing it. And I think risk management is critical today.
Risk management is critical today, and that's exactly how I view it. I feel like this is one of the most important times to really watch your levels of risk, really understand what you're doing in the market. When you're just in kind of like a upcycle, the Fed's working with the market, everything like that, right? Yeah, it's no problem. Just buy stocks, go to sleep. Like it's cake, right? But when you're in this sort of a cycle, this is for the pros, okay? This is for the people that have been in this game a long time now at this point in time, okay? You got a Fed that is fighting against the market and fighting against the economy, and not in a small way, in an epic, massive way, like the most massive way we've seen in, honestly, decades, right? So you have that transpiring while you have still a relatively hot economy and you have a very low unemployment. What happens to the economy if unemployment goes to 4.5%, 5.5%? That's going to cause some real problems out there. What does that mean for earnings, right? Then what do you have when you have a market move from inflation to deflation and you have more pressure on margins, but instead of this time, it's pressure because your inputs are high, but it's a pressure because, you need to bring down price. So that's, risk management is key right now in this market. It is absolutely key. This is no longer just a market where you can just do anything. It's a whole different ballgame now at this point in time, folks. So You know my approach in the market. Obviously, if you want to learn much more into detail, then apply for my private group. That's a pinned comment down there. I go through hedging strategies in there. I got some amazing videos on hedging, how I hedge in the market. Constantly, obviously, always talking about kind of risk-reward profiles of different stocks in different market cycles and things like that. So, yeah, if you're looking to kind of take your game up to the next level and really conquer this market and get through whatever we got to go through here and then come out the other side better than ever, then definitely apply for my private group. That will be pinned comment down there. Much love as always, folks. Thanks for being subscribed, new all-time high subscribers, and have a great day.